Hey students! Here's a big question. Is saving money at home actually bad for the economy? Let's break it down using the Loanable Funds Market. What are loanable funds? Loanable funds are the money available to be borrowed, usually through banks and credit unions. The Loanable Funds Market connects borrowers, they create demand, and lenders, savers, they create supply. Let's break down both sides. Demand side. People borrow money to buy big things, homes, cars, college, or expand a business. But how much they borrow depends on the real interest rate. That's the interest rate adjusted for inflation. High interest rate? Borrowing drops. Low interest rate? Borrowing increases. So, the demand for loanable funds is inversely related to the real interest rate. Supply side. Where does the supply of loanable funds come from? Savings. But not your piggy bank or money hidden in a jar at home. Only money saved in financial institutions can be lent out. That's what boosts the economy. There are two key sources of savings. Private savings, from individuals like you and me. Public savings, when the government has money left after expenses for an investment, can also influence the supply, but we'll cover that in another unit. Now, when interest rates are low, people save less. Right pointing arrow, less supply of loanable funds. When rates are high, people save more. Right pointing arrow, more supply available. Together, supply and demand determine the real interest rate. So, is saving money in a jar bad? Yes. Keeping cash at home reduces the supply of loanable funds, which drives interest rates up and slows investment and economic growth. But if you deposit that money in a bank, or even lend it to someone with a good business idea, that increases the supply and supports the economy. Government deficit spending. Now, here's a common test question. Pushpin: what happens to the loanable funds market when the government increases borrowing, deficit spending? There are two ways to show this. Shift in demand. If you include public borrowing as part of demand, more government borrowing increases demand. Right pointing arrow, higher interest rates. Shift in supply. If government borrowing reduces public savings, the supply of funds decreases. Right pointing arrow, interest rates go up again. Either way, the result is the same. Upward trend, higher real interest rates. Downward trend, less private investment. This is called crowding out. When government borrowing unintentionally hurts private investment. Key takeaway. Light bulb: the loanable funds market is all about borrowers versus savers. Money bag, but only money saved in financial institutions contributes to economic growth. House money in a jar? Not helping anyone. Check mark if this video helped you understand Econ better. Don't forget to like and subscribe. Books: check out my ultimate review packet. It's got study guides, practice questions, FRQs, and even full-length exams. Bullseye. And now, pop quiz time. Pause the video, try the questions, and check the answers in the comments. Thanks for watching. See you in the next one.